Welcome to the investment finance session of ABFER. I'm Alauddin Hamid from National University of Singapore. We have 4 excellent papers, and we will have the standard format of 20 minutes for presentations, 15 minutes for discussion, and we will open for Q&A for the last 10 minutes. And if you have any of the attendees, if you have questions, including the panelists, please post your question on chat. I'll monitor the chat box, and either I'll read out your question or I'll let you ask the question. Okay. So with that, let's start with the first paper on sustainability or performance, ratings and fund managers' incentives. And the presenter is Mariassunta Giannetti from Stockholm School of Economics. Okay, Mariassunta, it's all yours.
Yes. So thank you, Alauddin, for having our paper on the program. So this is a joint work with Nick, who is online, and Rachel Lee from the University of Alabama. So what do we try to do in this paper? Well, we want to connect to this broad debate about whether whether transparency can increase sustainability. And in order to evaluate this question, in our view, it's important to understand how investors solve the trade-off between sustainability and performance once this becomes very salient. And we think that we have a great setting to ask this question. That is the introduction by Morningstar of the global ratings. Now, we know from the work of Sam Alsmak and Sussman on the Journal of Finance that all things being that when these ratings were introduced, that they increased the flows into these mutual funds. But this is what happened just in the aftermath, and is largely all things being equal. The issue is that ratings change the equilibrium. So in the longer term, things are not equal. In particular, if high ratings for the mutual fund portfolio sustainability bring inflows, it makes sense to think that the demand for stocks that can help mutual fund to increase the ratings will increase, and these may affect the stock prices and future returns. In this context, a trade-off between sustainability and performance may emerge, and it's important to understand how investors react. So let me go a bit more in detail through the institutional setting that we use. So as I was mentioning, in March 2016, Morningstar introduced the global ratings. These ratings range from 1, the lowest, to 5, the highest, and basically rank mutual funds within Morningstar categories on the basis of the sustainability score of their portfolio. Think of these sustainability scores as a weighted average of the sustainability rating of the stocks in the mutual fund portfolios. And as I mentioned before, we know that in the 6 months after the introduction of the ratings, these funds experience higher flows. However, Morningstar also rates mutual funds on the basis of performance. That is, there are the star ratings that have been shown in a number of papers to be highly important for inflows into the mutual funds. And this star rating rank funds within the same Morningstar categories on the basis of the historical performance. Well, basically, what we show in this paper is that after the introduction of the ratings, the equilibrium changes. Okay. And funds change their investment policies, and in particular, funds with stronger incentives to improve their globe ratings in order to attract flows, demand more stocks with high sustainability scores in order to basically improve their globe ratings. If we start here, this would seem extremely good news that increasing the transparency of the sustainability of the fund portfolio seems to affect the allocation of capital. However, the story doesn't stop here. We show that this, of course, affects stock prices, and on the way forward, the stocks that experience buying pressure from funds that aimed to increase their globe ratings underperforms. The contrary is true for stocks that the mutual funds that were aiming to improve their globe rating sell. So, since this affects the performance of mutual funds, we show that there is a trade-off between the performance of between sustainability and performance. In particular, the funds that improve their globe rating end up to be downgraded on their performance rating. We also show that funds that buy more stocks with high sustainability ratings in order to improve their globe rating have lower alpha. So what are the flaws? Perhaps investors just want more sustainability and do not care as much about the performance. Well, what we show is that the effect of the globe ratings on flows vanishes in the second half of our sample. That is basically after 9 months from the introduction of the ratings. And also mutual funds seem to stop to trade in a way to improve their sustainability rating. And as a consequence, we don't observe any longer that the stocks with high sustainability scores become overvalued. Okay, so basically, once we look at all the equilibrium effects, we see that once the trade-off between sustainability and performance becomes very salient, investors seem to prefer performance to sustainability, and the ratings stop affecting the allocation of the portfolio of these mutual funds. So in this particular context, transparency fails to affect the allocation of portfolio. So let me walk you through our empirical analysis. So basically, I want to show you how an equilibrium changes. So I will show you the effect on the demand of funds that want to improve their globe ratings, effects on returns, and then effects on flows. And I will show how this changes in different subperiods. So the first step is asking how the introduction of the globe ratings affect the stock demands of funds that aim to be sustainable. So let me show you how we do this. So our dependent variable here is the position change of the fund relative to the total net assets under management at T-1. So if the fund cares about improving its sustainability score, would want to increase its position in stock I that have a higher ESG score. Now, which funds would have stronger incentives to do so? Is what we label border fund. Border funds are funds whose portfolio level sustainability score is close to the break point for the next rating. So these are funds that do not want to be downgraded or have a high probability of being upgraded. So the funds with the strongest incentives and higher probability of being upgraded. So what you see is that these funds are the ones that increase their position, and that the effect in stocks with high ESG scores, and that this effect is driven by the first half of the subsample. Of course, there is a lot of noise here because basically there are lots of stocks with similar ESG scores out there, and funds change their portfolio also in a way that is consistent with their investment strategy. So in order to try to reduce this noise and to bring some more evidence for the story we have in mind, we try to single out the funds that have even stronger incentives to improve their globe ratings. And these will be funds with few peers. So remember, the global ratings fund rank funds within a Morningstar category. And funds with few peers who with a few peers are more likely to be upgraded because they have fewer funds of which they have to be better. In Morningstar categories with very many funds, it might be harder for a fund to be upgraded because the number of peers that must be that the fund must become better off is larger. And what you see is that the effect is in the first half of the subsample is indeed stronger for these funds. So the first step that is that, well, it looks like that the introduction of the globe ratings affect funds demand for stocks with higher sustainability scores. So we ask, what is the effect on the stock prices? So in order to do this, we have to create a measure of demand pressure created by funds that aim to improve their globe ratings. And basically, we look at the abnormal trading of this fund in a given stock during a given quarter relative to the trading of all the other mutual funds. And we have two definitions of funds that aim to improve their globe rating. A definition is exposed and is based on funds that end up to actually improve their globe rating. The other definition is ex ante, and we focus on the demand pressure created by the border fund. So what do we observe when we aggregate at the stock level? So here we are looking at how this demand pressure created by the desire to improve sustainability rating is related to the stock ESG effective scores. You see that in our overall sample, there is a positive correlation, but this positive correlation is overwhelmingly driven by the first half of the sample. It almost disappears in the second half of the sample. So, and we can show that this is the case also once we control for other stock characteristics. These affect stock prices and stock returns. So in order to answer this question, we look at the exposed stock return, and in particular, we consider a portfolio that is long stocks that the funds that end up improving their globe rating sell, and short the stocks that they buy. What we observe here when we look at this long-short portfolio? Well, you see that trading against funds that have a strong incentive to improve their sustainability ratings generates a positive alpha in the period immediately after the introduction of the global ratings. So, and this, of course, might generate a trading opportunity for funds that do not care about sustainability. In particular, we look at funds that might have a strong incentive to improve their performance in order to achieve a better performance rating, a better star ratings. And there is overwhelming evidence in previous literature that the star ratings matter a lot for flows above and beyond the effect on performance. So what you see here is that other funds. So here we are taking out the funds that end up improving their global ratings. And what you see is that the other funds are increasing their holdings in stocks that are experiencing a selling pressure by the sustainability-driven funds. And the effect is driven by the first 9 months of the sample. And it becomes stronger as we focus on funds with an historical performance that places them very close to the cutoff for the next star rating. So these are funds that don't want to be downgraded or that want to be upgraded. And again, this effect is largely driven by the first half of the sample. Now, given what we observe on the stock performance, what we see that there exists a trade-off between sustainability rating and performance rating. So what you see in this table is that almost obviously, funds that are buying a lot of stocks that have high sustainability scores achieve a better global ratings. But these funds in the first half of the sample, when the stocks with high sustainability scores perform worse, also have a downgrade of the star rating. And a different way to see basically the same trade-off between sustainability and performance is to look at the fund's 4-factor alpha. And what you see here is that the funds that were buying most of these sustainable stocks in the first 9 months after the introduction of the global ratings have worse performance. So the question is, why does the equilibrium change, and what do investors realize about this trade-off between sustainability and performance, and how do they solve it? So here we are. So what we do is that basically we look at the flow at the inflows and how into the various funds, and how these depend on the ratings, controlling for all variables that have been known to affect the fund flows. So what you observe here is that in the first half of the sample, we can basically replicate the result of some hallmark, that is, funds that have a very high sustainability rating attract inflows, and funds with the bottom sustainability rating experience outflows. And as in a wealth of previous literature, the star ratings are very important for flows. And this result in the first half of the subsample is very robust to different specifications and so on. We move to the second half of the sample, in which we do not find any effect of the global rating on trading returns and so on. And what you observe is that, the globe ratings do not seem to matter any longer. And this is, again, true in different specifications and settings. So we ask, why is that? So our favorite interpretation from which I started is that, investors realize of the trade-off between sustainability and performance, they stop investing in the fund. And also the incentives of the fund managers are such that if conquering a better globe rating implies downgrades from the point of view of the star rating, the incentives are no longer there, because what you observe here is that the coefficient on the star rating is larger in terms of magnitude. So the net effect would mean that there is a decrease in total net asset under management. There is, however, another interpretation that could rationalize these changing results. So that could be if globe ratings do not change much, because some funds always invest in stocks that are very sustainable. And therefore, at the beginning, when the globe rating are introduced, the investors that care about the sustainability may simply have reallocated their portfolio, and they are in steady state. So this is the reason why we don't observe any longer an effect on flows. Okay, so is this possible? So this alternative interpretation would rely on the fact that globe ratings do not change much, so investors do not have to reallocate their portfolio. And what you see here is that it is not true that globe ratings do not change much. So both in our finding and in some Asmark paper, the globe ratings that matter are the bottom and the top. And what you see here in panel B is that, if anything, the bottom and top rating are changed to a larger extent in the second half of the sample than in the first half of the sample. Okay, so it doesn't look like that the industry has reached a new equilibrium, and therefore there is no need for more reallocation. And another way to consider this is just to look at the effect of rating changes on flows. And what you observe here is that star downgrades and upgrades continue to matter for flows, but globe downgrade and upgrade actually never matter, even in the first part of the sample. So it looks like that investors reacted only to the first globe assignment, and then this globe rating stopped mattering. We also consider different metrics. So, for instance, it's a bit of a puzzle that is linked to the salience of the rating, that investors react to rating at all. So Morningstar provides investors information about the portfolio sustainability scores. So both retail and institutional investors may simply react to it. But what we observe here is, again, the portfolio sustainability score matters only in the first part of the subsample. And we consider different metrics in the paper, but I won't have time to discuss it. So what is here the main punchline of what I've shown you? Well, the introduction of the globe rating might have made the trade-off between sustainability and performance very salient, precisely because an upgrading globe rating was likely to translate in a downgrade in the star rating. And it looks like that that investors stopped following globe rating and just considering performance rating. So this cast doubt that at least in the mutual fund industry, greater transparency may lead to more sustainable investment. Thanks a lot for your attention, and I look forward to Darwin comments.
So Darwin, it's yours to go for the discussion.
Thank you. So thanks for asking me to discuss this paper by Mariassunta, Nick, and Rachel. So they have a very nice and interesting setting to look at the trade-off between sustainability and performance. So in particular, they have the Morningstar sustainability ratings, or they are also called the globe ratings because they look like the shape of a globe. So a fund can be awarded 1 to 5 globes according to their portfolio sustainability score. Now, contrast these ratings to the traditional star ratings, which are based on past performance of the mutual funds. Now, what Mariassunta and co-authors find in their paper is that now these two ratings, when the globe ratings were introduced in 2016, seem to go in opposite directions. So funds that try to improve their globe ratings will see a lower star ratings because their performance is hurt. Now, the bigger question that they ultimately ask in the paper is, well, since investors like both sustainability and performance, they face a trade-off, they have to choose. So at the end of the day, whether they care more about sustainability or performance, and how will funds respond to this investor's preference. Now, what they found is, at the beginning, when the globe ratings was introduced in 2016, high globe ratings, so funds with high globe ratings, really attract more flows. And this is consistent with Hasmark and Sussman in JF 2019. Now, in particular, so funds try to increase their globe ratings by buying stocks with high sustainability ratings. Now, however, the buying pressure from these funds will push up the price of these high sustainability stocks, and then hurting the future expected return of these stocks, and ultimately hurting the future fund performance. Now, what Mariassunta, Nick, and Rachel find in their paper is that a new equilibrium seems to have emerged in 2017, so shortly after the globe ratings were introduced. Now, they find that in 2017, high globe ratings do not attract flows anymore. So investors do not respond to the globe ratings, and funds do not attempt to increase their globe ratings because they care more about performance. Okay, so now this is the conclusion. Investors care more about performance over sustainability. Now, this is a very important cautionary note for those of us, including myself, that do research work in climate finance, in ESG investing, because we know ESG investing has been growing over time. It's increasing in popularity, both in the industry and in our academic literature. Right, so to quote you some numbers here, so United Nations supported initiative called the PRI, Principles for Responsible Investment. As of last year, there are over 3,000 organizations that have signed their name there, pressing for more ESG investment, and with a collective AUM of over 100 US trillion. And a survey paper by Puger, Sondner, and Starks in the climate finance issue in the RFS, in the survey, they find that 43% of the funds, they engage with the management companies regarding climate risk. They really care. Now, however, this paper by Mariassunta now put a big cautionary note here, right? So now if performance has to suffer when investors care about both performance and sustainability, now funds will trade performance off with sustainability. They care more about performance, right? So like whether ESG investing is still effective, is still trying to create a better ESG environment is a question. Now, there are a lot of things to like about the paper. This is a very interesting setting. And for the remaining time in my discussion, I will try to offer some arguments to try to like further strengthen the analysis and the conclusion. Now, the conclusion is that investors prefer performance to sustainability. This conclusion seems to be based on two premises. So first of all, at the stock level, high ESG rated stocks have lower risk-adjusted return. So that when funds want to improve their ESG rating, they have to suffer from a poorer future fund performance. The second premise is Morningstar's group ratings are a good measure of investors' perceived fund portfolio sustainability. Now, the first one is supported by the paper's analysis of a shorter sample. So this is based on March to December 2016 when the group ratings were introduced. I will offer some more argument that maybe they can extend this to like a more general environment, right? Because here the analysis is over a short time period, only 9 months, and this is when there is severe buying pressure from mutual funds that try to improve their group ratings, right? So what if in a more general environment this buying pressure is not there or is weak? And in a time period that is different from this, whether we still have this trade-off at the stock level. Okay, so and I also hope the authors can think more about the second premise that I will mention later. Now, for the first one, like whether at the stock level, high ESG rating lead to low future return, like most of the things we look at in our academic literature, the evidence is divided into 3 camps, covering all the possible answers. So some people say yes, so high ESG rating means low return. And sorry if I missed your papers here. There are a long list of papers here, and I only list a very small subset here. So, and some of these papers don't look at E, S, and G entirely. So they may look at a subset of E, S, and G. So E being environmental, S social, G corporate governance. So some papers said, yes, high ESG rated firms have lower returns. Some people say no. And this literature, you can also say they are saying funds can do well by doing good, right? So they can invest in high ESG rating firms and at the same time achieve high returns. And some people claim there is no relationship between high ESG rating and future return. Now, fortunately, I think Pastor, Stenbaugh, and Taylor, a forthcoming JFE paper, offer an explanation. So they have a theoretical model showing that high ESG rated firms should earn low risk-adjusted returns over the long term. But they also offer an explanation to reconcile all the contradicting empirical evidence that we see, right? Because in the short term, if ESG tastes shift unexpectedly, so if there is a stronger demand in ESG, people suddenly like ESG more, then it is possible that high ESG rated firms can outperform. So I think the authors can rely more on this literature that there is indeed a trade-off between ESG rating and low return. So even outside of their sample period, and even in the absence of the buying pressure from mutual funds, so that we know that even now we still face this trade-off. Now back to the paper's explanation about the buying pressure. I also have a comment on that, and I wish the authors can do a further check on this. Now they show that mutual funds that improve the group ratings, they buy stocks with high ESG ratings, right? So I encourage them to look at other investors that are not mutual funds, right? So they only look at mutual funds, but I urge them to look at like other parts of the investors. Now, I can come up with reasons why investors other than mutual funds will also buy stocks with high ESG ratings, right? So in this particular time period, March to December 2016. So first of all, Paris Agreement was passed in April 2016, and investors at that time were probably becoming more aware of climate risk. Now, secondly, my paper with Zhenyu Gao and Wenxi Jiang presented in this conference 2 years ago, we show that attention to global warming is higher when the local temperature is abnormally higher. Now, we also show that retail investors respond to the local temperature, right? So when that happens, they care more about global warming, they buy low emission stocks and sell high emission stocks. Now, I went back to check our data. We have an international panel, so we only look at the location of the stock exchange. So we only have the temperature in New York. So I went back to check the New York abnormal temperature in the sample period. So March 2016 to December, there are indeed a few months that are abnormally warm, right? So here the abnormal temperatures are defined based on a past 10-year average. So if you believe in our story, it is possible that in some of these months, retail investors are also buying the low emission firms, and many of these low emission firms are also high ESG firms. By the way, if you're interested, the temperature data are available online from our websites. Now, my suggestions for the authors is maybe it is worth checking who is also buying and selling stocks with high sustainability. Now, of course, their paper look at within the mutual fund universe, they look at funds that do not improve the growth ratings. They are taking the opposite position and their performance is improving. But my suggestion is to check other investors other than mutual funds. Now, our RFS paper, we have a way to classify investors into retail, institutional, and block holders using, again, we have international data. We use FactSet and DataStream. Now, in the US, you can rely on 13F to do the classification, right? So we define 100% minus institutional minus block holders as retail. In our case, block holders seem to be trading in an opposite direction of the retail investors. What I'm hoping in this paper is that they can show that retail investors and block holders, they are not net buyers. Okay, so, or at least their buying pressure is lower than the buying pressure from mutual funds that improve the growth ratings, right? So to show that really the buying pressure from the mutual funds distort the equilibrium prices and the future returns. Now, another suggestions I have is the events I mentioned, mostly the climate events, they affect stocks with high E ratings, so environmental ratings. They don't affect so much about S and G. So maybe you can study S and G ratings separately. Now, on the second premise, so where the growth ratings are a good measure of the
Darwin, you have 3 more minutes.
Yeah, sustainability at the portfolio level. Now, I have a behavioral explanation of their finding that growth ratings probably were more salient when they were introduced, but investors care less about them afterwards, right? So investors may still care about sustainability, but they don't just pay attention to the growth ratings. They derive the fund sustainability using some other ways. Okay, so now I went back to the Morningstar website to see how the information is presented. So from the Morningstar website, the first page of a fund showed the analyst rating, which is not the growth rating, which is not the star rating. Analyst rating is something else based on the forward-looking performance that Morningstar has their own analysis on. Okay, so now if you want to get the growth ratings or the star ratings, you have to click through the subheadings here, right? So here we see the quote here is being the first page. We also have performance and portfolio. You have to click through them and then browse to scroll to the middle part to get these ratings. Now, I have the web links here, and for the interest of time, I'm not showing them. Now, what I want to tell from the website is that the analyst ratings are the most prominent. They are on every page when you click on the fund. Now, and it appears that the analyst ratings and star ratings, one is forward-looking, the other is backward-looking, they're highly correlated. So what I'm saying here, maybe growth ratings are not as salient as the star ratings. Now, to the author's defense, they have a table showing that the results hold for both retail and institutional share classes. So to the extent that institutional share classes, the investors are more sophisticated there, maybe this is not a very important problem. Now, I do have a follow-up point, which is based on a more rational argument. Maybe growth ratings are not the best measure of the fund's portfolio sustainability, right? So to give you some background, that the growth ratings are derived from a weighted average stock-level sustainability score, and the score comes from a company called Sustainalytics, which is acquired by Morningstar. Now, in a perfect world, when there is only one measure, this will not be a problem, but there is a highly cited working paper by Berg, Cobo, and Rigoben, and Berg is the author of the second paper in this section, so maybe the paper next will also tell us more, that ESG ratings from 6 leading rating agencies disagree by a lot, and Sustainalytics is one of these 6. Now, the correlation between the ratings on the same firm across the 6 agencies on average is only 0.54. So this is the pairwise correlation between each pair of the 6 rating agencies, and the correlation range from 38% to 71%. This is actually surprisingly low, right? So the story here is lacking a true rating. It's very difficult to solve this issue. So I don't know how doable is this. So like if you can acquire assets of the different rating agencies ratings, you can conduct robustness check to see if your results go through, or you can focus on some subcategories there where the different agencies tend to agree more. So here the E dimension, the environmental dimension, they tend to agree more. So you can refer to their working paper for these numbers. Now, I also have a suggestion on the main results using the group ratings. So in some of the tables, when Mariassunta defined the abnormal trading pressure, they have 2 ways to identify funds that improve their group rating. So one is an ex-post measure that funds really improve. The other is an ex-ante measure, funds are near the cutoff. My personal opinion is I think the ex-ante measure, the second measure, is better. It really showed that the group ratings cutoffs matter. Now, because if you look at the actual increase in the rating, maybe they are not really using Sustainalytics ratings. Then maybe they improve using some other ratings that are not captured by Sustainalytics. But if you use the cutoff, it's difficult to argue it's just not based on the group rating. So I think the group rating cutoffs is a better result, is cleaner. It really showed that the group ratings really mattered in that period. I suggest the authors move it to the main analysis. Okay, so finally, again, I think this is a very exciting paper, lots of interesting results, lots of things to like, in the midst of particularly the growing popularity of ESG investing. I encourage the authors to think more about the trade-off between ESG rating and return, and also where the group ratings is a measure of portfolio sustainability. Thank you.
Thank you, Darwin. That was Darwin Choi from Chinese University, Hong Kong. I'm going to pass the mic back to Mariassunta to make some quick responses to the comments.
Darwin, thanks a lot for the comments. I think these are terrific comments, and I actually agree with most of what you told, meaning that the way in which I see our results is that we are exploring whether market mechanism might work in a specific context of the mutual fund industry. So in the moment in which we start looking at other institutional investors, actually also Nick and I with Rachel have another paper in which a different market mechanism seem to work. Okay, so what is the mutual fund industry, however, may attract investors that care more about the performance, and these globe ratings at the end don't appear to matter much. Now, I want to clarify that when we look at the effect on the exposed return, we really want to look at the effect of the demand pressure, rather than the effect of the ESG rating. And there is not a one-to-one correspondence between the two because of the different trading strategies. So I think it's, I don't want to get into the debate of whether ESG increases returns or not. There are different ESG factors. What I want to say is that there have been in the last couple of weeks lots of news about confusion about whether ESG is a predictor of better performance, okay? And in this context, it seems that when investors realize that it's not necessarily, then they care mostly about the performance. We try to do something about the different metrics. So for instance, I think I agree that the different ESG rating knows what they capture, right? So we use the experiment that Morningstar provides us, but for instance, Morningstar came out with a different rating that is more related to climate risk and is the low carbon designation. And even if we use that, then doesn't seem that mutual fund investors care, but we really don't want to say that no investors care about ESG. And we even have a different paper in which basically we say that the market mechanism work. And I don't know whether Nick wants to add something. So.
Okay, so we have
Nick,
3 questions. So
Nick.
let's see if we want to take a key phase question first, and then we'll move on to Johan's question.
Okay, can you hear me?
Yeah.
Mariassunta, very interesting paper. I have a question or a suggestion. It seems like what's happening in your paper is that when Morningstar introduced the global rating, mutual funds crowded into high ESG stocks and pushed the price to an overpriced value. So they're not properly accounting for the externality that trading is generating. I wonder if you can conduct some cross-sectional analysis and see which funds or which fund families are more likely to like take into account this. Like maybe larger families, they understand if all their funds start buying into high ESG stocks, that will have adverse consequence, and hence they will refrain from overlay purchasing those high ESG stocks.
So I think I generally really like to think of trading externalities. I actually have ongoing and past work in which I consider all of this. I'm wondering, however, whether this is the right setting, in the sense that these globe ratings were just introduced. And I'm wondering whether it would be too much to think that mutual funds can predict that everyone will crowd in these stocks to improve the globe ratings, and therefore these will become overvalued. So this is one reason why I am a bit reluctant to go for this cross-sectional effect. Again, because this happens in an interval, and then either for the reason we say or for lack of salience, as Darwin was saying before, these equilibrium changes, and perhaps this 6-9 months is too little for families to figure out of the externality and to back out. They could have been the first to withdraw from the market, though, so we could check that.
Agree.
Johan, you want to go with the last question? I think we'll skip the Roger's question. Not enough time.
Sorry, Roger. Very nice presentation, Mariassunta. I'm just curious as to what your thoughts on the noisiness of the globe ratings, because I think Darwin brought this up earlier. My prior on this is that institutional investors have always tried to minimize the exposure to negative environmental and social factors, presumably because they're worried about scandal risk. In 2016, perhaps there's a shock to which some institutional investors or funds become more sensitive to this. And then after that, maybe there's not a lot of variation across funds in terms of their avoidance or their sensitivity to these negative stocks. Now, having said that, I'm worried that basically at the end of the day, the globe ratings are not that meaningful beyond 2016 or 2017 because there's not a lot of variation in terms of the actual sustainability of these funds.
So okay, let me. So, first of all, this is the experiment that Morningstar is doing, right? So I think that one way to see it is that not every transparency work. So perhaps investors didn't like these globe ratings, but I thought that it was interesting that investors do not want to be exposed to negative ESG factors, so that to some extent is also what we find, in the sense that it's only the funds that appear particularly desperate to improve their performance, to jump their performance rating, that buy those stocks. Okay, so they might have some other stronger incentives. Okay, but of course we can evaluate this metric. The only thing that I can tell you is that if I look at the low carbon designation and its effects on flows, the results don't change. It doesn't seem to matter when it's introduced in 2018. So that's actually, I read Roger's comment, and he's talking, could it be reverse causality? That is, funds that are performing poorly are pursuing the globe ratings. To some extent, I think that this interpretation is not so disruptive in our context, because we look at an equilibrium, okay, in which some funds at the beginning pursue sustainability and some performance. And then this equilibrium changes and everyone seems to care about the performance. So I'm not sure it's very important what comes first, but thanks a lot for all these comments. And
okay.
I don't know whether it's a minute for Nick.
Thank you.
Yeah.
Thanks for the good, nice discussions.